Hold on, I gotta talk to Aldo real fast. Hold on.
Oh man, let him know he's live.
Aldo,
Put
you're
him on
live on
speaker.
TYC.
Oh my gosh, you should have put him.
Hey, you're live on TYC, Aldo. Talk to the viewers.
Aldito,
Hey, Marcos, are you recording? What's going on?
we're recording, man. You're live with our
Sorry
viewer.
to bother you.
We're
Tell
live, man.
Tell our viewer what they should be listening to and looking at today.
They should listen to Brett and Marcos. That's all about it.
That's the only answer, my man. That's the only answer. Wait, Aldo, you one question for you. Participate in our predictions. Where do you think the 10-year treasury is going to be at the end of this year?
I think it'll stay where it is now. I don't think we have the recession yet.
So you don't think it's going to move?
It might end up in the fours. Low.
Well, that would be not congruent with my prediction. So, Aldo, we're putting you in at a 4-1 because, yeah, okay, 4-1 for Aldo. Thank you. All right, man, I'm ready to talk earnings.
Starting with your charts.
No, dude, I think maybe you let me just riff on this one, and I'll do all of my charts, and I just make sure that you give as much back and forth as possible.
Okay, well, let's at least allow spots for me to interrupt.
I promise. But also don't be afraid to say, hey, time, young man, time.
You put yourself in the young camp, which means I'm the old camp. Thanks, Marcos. Go. Let's begin already. I'm hot.
Wow. Oh, man. That's a great segment, by the way. Brett is hot. That's a good one. And then we do flames.
Like the billboard, your wife is hot?
Yeah.
But
that's a really good one. That's a really good one. Yeah. That's a good segment. Brett is hot. And then you can say what's pissing you off.
Oh, we don't have enough time.
You know what's really grinding my gears?
I could be like Andy Rooney. You know Andy Rooney?
Oh man, Andy Rooney. And you're trying to defend that you're not old?
He's awesome.
That's so perfect.
Andy Rooney is still good for young kids.
Bro, I'm pretty sure Andy Rooney died before most people that work here graduated college.
That's fine. So. His stuff was still good, and it was what he complained about. So let's do it. Andy Rooney's hot every episode.
Do it. Let's start off with that segment. All right. 3, 2, 1. Welcome to Talk Your Chart episode 30. I am Marcos Segrera here with my colleague Brett Horowitz. Brett, how are you?
I'm good. Today is February 24th, Marcos. We got some interesting news this morning about inflation, and the last few weeks have been trying times for investors. So why don't you start us off with what you want to talk about today?
Sure. So I actually have a few charts, BH. Everything is earnings related. Why do I bring everything earnings related? Because the market is up from the October low. That was October 12th, around 3,500 or so. We're up 14% off those lows. But we're getting all these relatively hot inflation readings, CPI. We got PCE today. The Fed has not removed their hawkish tone, right? The January jobs, remind me, was the January jobs hot or not hot?
No, everything's been hot. But look, the Fed's been very consistent every single month, saying we're going to keep rates high until this thing stops, until we're sure we've nipped it in the bud. Like, they've been very consistent. I'm not sure why the market doesn't buy it.
So there you go. So then why have stocks held up so well? And that is the question that I'm trying to answer with some charts and some help from Nick Colas, who's the co-founder of DataTrek. Let me read this really quick. He says, and I quote, "The only explanation that makes sense to us for this conundrum of bad news and stable markets is that U.S. corporate earnings power remains resilient. Yes, Q4 reporting has been disappointing in terms of revenue and earnings beat, but S&P is still expected to earn 53.34 per share." So what the dude's basically saying, and we always talk about this whole thing, is expectations and outcomes relative to the expectations are what matter. So if you expect bad and you get bad, that's a good thing. The bad would be expecting bad and getting terrible. Let me give you one quick stat here. Do you know the historical profit estimate beat that earnings have? Meaning when companies report, what's the percentage that usually beats estimates?
75%.
It's exactly 75%. Exactly. And in Q4 of, did you just guess that?
You just guessed this.
Holy Lord, ladies and gentlemen. Finally, huh? Finally. In Q4 of 22, that was 70%, so below average. And now let's talk about revenue estimates. Historically, the revenue estimate beat is a bit over 60%. I won't make you guess that one. And in Q4, it was 50%. So they are worse than historical averages, but that's what was already getting priced in.
Well, but there's two ways to look at that. Either one is analysts have to stop having expectations so low because they're clearly off, right? You'd want it to be 50% if you were in an ideal world, where half the time companies beat estimates, half the time they didn't. Or the other way to look at it is, as you said before, adjust expectations very low, beat it, and then everyone's excited about it afterwards.
Yeah. So look, let's go to the tape. And again, generally speaking, companies always beat. That's why be invested in the market. Your number one goal should be get exposure to the secular growth of economies and companies. First chart, BH, we're looking at quarterly earnings per share, actuals and estimates. So we can see here, if you look at the x-axis, the bottom part of the chart, the first one that is checkered, not solid blue, that's Q4 of 22, when the quarterly profit estimate was 53.34. Next quarter, which is the one we're in right now, it drops to 51.70. And then we start coming back up in Q2 of 23. So on a relative basis, it doesn't look so bad.
I don't see that happening. I mean, I think why the market's been so resilient as well is because the data that's come in has been pretty good. Everyone keeps pushing back this idea of a recession or a hard landing, maybe no landing, maybe it's not till next year. So I think now we're in kind of the sweet spot where things are good. But I'm worried that as we get closer more into the year, based on what we've seen the last month, it's going to take longer to get back to those higher figures. Like, I don't see that happening at all.
Let's see what happens. It's what's priced in. It'd have to be, again, you have to get the typical earnings recession. Let's see if it happens. Next chart, it just gives it year over year. And this is the one that I think articulates more of your side of the coin of talk about not being pessimistic enough.
Yeah, for sure.
Right? So if you look at, again, once the solid blue goes away, now we're talking about estimates. So for 2022, and it came in right around that 219.57. Now for all of 2023, we're still expecting an increase in earnings. And look at the jump into 2024. So with this stuff priced in, right, what are the outcomes, right? What are the opportunities for a big surprise?
Hey, there's not a lot out there that could, it would take a lot for that to happen, right? I mean, you're talking about lots of things to go right. You're talking about inflation to come down. You're talking about the recession to be very mild. You're talking about the dollar to remain strong. You're talking about the consumer to still have their jobs. Like, a lot has to go right for those things to all happen.
Yeah. Even if they revise these things down or actual ends up being a bit worse, I don't know that you're retesting the lows from October unless something that we're not expecting happens. I think
like inflation's the big thing, right? I mean, we are now getting back some hot inflation numbers. So they've come down. We didn't expect them to come down every single month. The trend has been down, but the last month or so, you've seen a huge spike in retail sales, the huge spike in jobs we talked about, and now the PCE, which is inflation. Like, that could bring us back to Fed raising rates a lot more than just 3 times this year.
The year over year in CPI was 6.3 for January, right? So that's obviously not good. That's headline. Core was 5.5. Based off what I've seen, read, and heard, getting from 5.5 to 3.5 is not going to be hard. It's going to get from 3.5 to 2. That'll be hard. My estimation is that once we get to 3.5, the Fed is going to say, that's not so bad. We're okay with being above trend since you've been below trend for so long.
Yeah, I mean, they said that before, that they were okay with that, because we had, 10, 15 years since the 08, 09 crisis where inflation was super low.
Yeah,
And so
exactly.
I know people complain about this last year, your grocery bills, the cost of eggs, gas, all this stuff, but we got a huge benefit for 10 years plus where inflation was super, super low.
Yeah, I hear you. So look, now let's fast forward, right? Let's assume earnings tumble, they go down like crazy. What do recoveries look like? That's what this next chart is. Earnings typically recover stronger than they fall, right? Again, how do you participate in this? You got to be present. And then what's interesting, drop to the next chart right after this, equity stocks typically find a bottom 6 to 9 months before earnings reach their low. So what does that tell you? We're probably closer to the bottom than the beginning of this whole thing, right? We're definitely closer to the end of the hiking cycle than we are to the beginning of the hiking cycle. Is that safe to say?
Oh yeah, for sure. We're probably in the 7th inning, whether it's 2 more, 3 more, 4 more, it's not going to be another 5% like we had in the last year. But I think this last chart is the best chart because we hear it all the time from clients who either have cash, want to put in cash, don't want to invest. They're waiting for the bottom to happen and they're going to be late. They're going to wait for that exact bottom to happen and then a little bit of recovery to happen. And now you're talking about being 6 months or 9 months after when you should have been a buyer.
Okay, so then now let me frame this, right? Why in the world is the market up 14% off lows from October 12th? Well, couldn't it just be that it's pricing this in? Right? It's just it's doing exactly what this chart is telling us. It's bottoming 6 to 9 months before it happens.
Right. Yeah. I mean, the Fed is still raising rates. You still have inflation out there. You have the earnings that are not so hot. But you're right. Everyone's looking beyond that and saying, okay, we're getting to the end of the story. There'll always be another story after that, but at least this thing is going to be done with, and we can move on to something else to talk about.
Good. I agree. Last chart, this is just for good measure, because over the short term, markets are unpredictable, right? That's why you get paid to be in them. However, over the long term, talk about a correlation between what companies earn and the movement of markets, right? Again, yeah, I get it. This is 1945 to 2015. I'm sure there's another one that's more recent, and I'm sure there's another one that doesn't start in 1945, right? Just out of World War II. But the reality is you can't argue with the correlation. The reason markets go up is because companies make money.
And this is why I think we've always had the belief in our firm that we're not in love with things like gold. We're not in love with things like oil. We're not in love with things like cryptocurrency, because you have a reason why stocks make money. It's not this casino game where you just money is moving around. You're trying to guess and predict, and you're making money because somebody's selling you something they don't want. Stocks are going up because there's earnings, because companies make money, and you as a shareholder of those companies participate in that.
Yeah, I think that's well articulated. And Howard Marks, the oak tree guy, he says something that I always thought is awesome, and I think he probably quoted Buffett, is you need to look at equities or stocks as something to hold, not to trade. Right? I think that's a fair way to put it. Anyways, that's my earnings rant, Brett. What do you got?
So I want to start off with some positives. The first chart here is the Purchasing Managers Index. This is basically saying, are different areas of the world in an expansionary environment or in a contraction environment? And we've seen these rises in the last few months, US, Eurozone, the UK, and Japan. So we've got some really good news. You couple that with what happened with the jobs report, and couple that with retail sales, and everyone's looking at this going, wow, the economy is really in pretty good shape, right? People have their jobs, people have are spending money. People are still feeling cooped up from the pandemic and trying to do these revenge things, go out to eat and travel and so forth. So look at that and say, this is some great news, right? But there's obviously a negative to that as well. And the negative is that, sorry, go ahead.
That, this is all the smart people that say, what are the leading economic indicators? They always tell you PMIs, right? Like, watch all these things. This will tell you what's going to happen. This is one of the biggest components of the hell is that freaking thing called? The conference board, the leading economic indicator conference board, blah, blah, blah. That thing is falling through the floor. One of the biggest components are the PMIs. So yeah, you're speaking to what everyone's looking at.
So when they put in the closed captioning after this, are they going to see blah, blah, blah? Or we're going to
That's a damn good question. And yes, I hope they do.
But then this is good, but it's also clients will say, well, this is so good. Why is the market faltering? Why are the last month are things going down? We look at another chart, where it looks at home sales by region. And here you can see gigantic declines from a year earlier in different parts of the country. And we knew that would happen because, right, one of the areas that hits the worst when interest rates go up is going to be your housing. It's going to be your Home Depot and your Lowe's. It's going to be everything related to moving and buying and renovating houses because interest rates are now so high.
Yeah, affordability is gone.
So it's no surprise that a week ago, Home Depot came out with earnings and said earnings are horrible. I mean, that's pretty obvious that they're going to be horrible because no one's moving.
I assume you saw the U.S. housing market down by as much as since the GFC, since the housing crisis of 08, right? 4.9%. I think $2.5 trillion wiped out in home value. But who didn't get wiped out, Brett?
Those of us that are still in our house?
No, those of us that live in Miami, because that was Miami, Florida was the most resilient of all the big cities that were hit.
Look, I mean, I think people tend to look at their house and they don't look at the value every day, so they're less worried about the drop, right? That's why I think the stock market can be a little more fearful for people because you see that value every single day. If your house had a value every single day, you'd probably be a lot more fearful about owning real estate, even though some regions like ours have been really hot the last year.
Yeah, precisely. There's resilience there, but not in all the other places. New York, that took it on the absolute chin. So I think the exodus is real. Ken Griffin has made his presence felt to the tune of tens of millions of dollars in our community very quickly. So I doubt he's going anywhere.
Well, that leads to traffic, and that leads to, I mean, you and I were in California a few weeks ago visiting clients, and out of the dozen clients we had out there, probably half of them have either left or in the process of leaving California because of the traffic, because of the taxes, because of infrastructure issues, maybe politics as well. But that could easily happen here, where suddenly we get to be too expensive. There's too much traffic. There's not enough metro rails and other buses to get people around, and you can't live here unless you're making $1 million.
Yeah, not at all.
The last chart I've got here is something that all clients are talking about, which is the debt ceiling is coming up. It needs to be raised for the quadrillionth time. So this chart is a few years old. It basically shows a pretty compelling point in that the debt limit has been raised or suspended. I don't know how you feel about it, but if clients are asking me about it, I'm saying I don't think it's going to be a big deal. I think they'll figure out a way to get it done. They always have. They always will. There's nothing worse than the U.S. defaulting on debt.
We're not going to default. And I say that because I'm 97% sure. So if it happens, it's not that I was wrong. It's that the 3% hit. So that's where I feel. Number two is it still can very much cause markets to not cooperate over periods of time. If you look at 2015, when it took them several months to get through this, markets were down over 10% while all this was working its way through. But what is it? Assuming you exhibit proper temperament, an obvious buying opportunity.
It's a short-term blip, right? I mean, that goes on for a few months. Everyone gets fearful. In fact, a lot of clients are asking about how do you protect yourself? One of the best ways is to buy protective put options, which are basically something where you'd make money if the market goes down. Those get very expensive around this time because everyone's fearful. And so the cost of that insurance goes up. But ultimately, we've gotten through this so many times before, all you're doing is paying money for something that's probably not going to happen.
Yeah, that's it. I look, not surprised if markets respond negatively, but ultimately we're high likelihood not defaulting. Something we got put into place. There's plenty of intelligent people that say this whole debt ceiling thing is absolutely silly. But it exists, it's there. Hopefully we can get a little bit of reining in of expenditures. But we'll see. That's it.
In the meantime, this is why
the political pantomime that is the debt ceiling.
This is why our clients have months or years of cash flow sitting on the sideline so that they can get through this without having to sell anything. Because it really is maybe a short-term blip followed by a rise right afterwards.
Yeah. And I was, hold on. So fact check. I said 2015. I was wrong. It was 2011. And the S&P fell nearly 17% between July 22nd and August 8th. That's a drop, man. 17%. I can't exactly remember what else was going on concurrently. Was that the Greek debt crisis also 2011?
I don't know. Every year was the Greek crisis or the Italy crisis. I don't remember that.
I think it was. I think it was. But anyway, so
All
yeah,
right, man.
it'll do it.
We will get through this like we have in others. Have a good one.
Brett.
Bye.